All right, we're back for another episode of the Mortgage Show, October edition, backwards hat edition. Beds, how you doing?
Good. How's Randy today?
Doing good, man. Fall's just cruising along. It's just kind of a blink of an eye. Feels like summer just ended like a week ago, but things are cranking right now.
Are the kids dominating field hockey?
They're dominating field hockey, but it's over in a week, man. Like, that's it. The season's over. So fall sports have been great, but now we're transitioning to some of that winter stuff over the next few weeks. It won't be long till we're skiing, my man.
And I was going to ask you about that. It's right around the corner. I'm excited.
Yeah, we get a little bit of snow being made at higher elevations of the mountains, so I'm excited about that. But yeah, man, everything's good. So just mortgaging, as you are as well.
How is mortgaging going?
Well, Chris, that's what I'm hoping to talk about today with you. There's a few different things we had planned to talk about. Biggest thing, why don't we just jump into it, is interest rates. It continues to be the topic that I feel like I'm discussing most. I don't know about you. A month ago, I think our conversation on the podcast was a little bit different. I think Federal Reserve had just cut interest rates. There was this feel that rates were going to start going down from here, and quite the opposite had happened. So I'll let you speak on it in a second, but I've been telling people I saw this. It was like refi boom of 2024, RIP, September 18th to October 1st or something like that. It was just like a 12-day window of time that we could refinance people, and just rates are at their highest point right now since July of this past year. So it's a weird time right now. What's the latest on rates?
So in anticipation of a Fed cut, prior to the rate being cut by the Fed, you noticed it in our interest rate pricing. Interest rates were going down. So the market was anticipating that lowering. So the bulk of the interest rate reduction happened weeks or maybe even a month and change prior to the announcement. So since the announcement, what's happened? You start relying on just the regular economic news. What's on the calendar? What's the expectation within that report? And when the numbers come out, does it meet expectations? So since the Fed cut, a lot of these, and they come out every day. Sometimes there's some stuff that like light days, but other days there's like 3 to 5 reports a day on the economy. And it has not been less than lately. It's been meeting expectations. So, mortgage-backed securities get worse and interest rates go up. And that's what's happened.
And it doesn't seem like there's that much to move the market between now and the election, or maybe now in the next few weeks. Now there's talk about the Fed maybe not cutting rates at the next meeting, or if they do, that's kind of the end of rate cuts for the foreseeable future, which is just a big change from what we heard a month ago. Correct me if I'm wrong, but Fed cut rates 50 basis points last meeting, right? And then there was talk of another 25 before the end of the year, and then another, I think, 125 throughout the course of 2025. But I think with the economic reports that we're getting, that's very much not on the table anymore, and it's not a guarantee that that's going to happen. It has put us where we are with the rates at that 4 or 5 month high.
What's interesting, too, is that some of these reports coming out as far as the job numbers are concerned have revisions the next month. So it's like, it's giving this impression that a month is sort of cooked, if you will. So, all the years of me watching, the recent release of economic numbers, I'm just confused by the amount of revisions the last 6 months and how it's affecting the bond market and what it's doing to interest rates. It's just running a little atypical compared to the normal flow that I normally see. So it's like I'm learning as this is happening. I'll be curious through the winter months, through the first quarter of next year, because we're seasonal now with spending. We've got Christmas coming up. You have families thinking about buying goods, and manufacturing should be up, retail sales should be up. When those numbers come out, it's going to be a telltale sign of the consumer's sort of buying and spending power. What is it going to look like? Is this the winter where finally the pinch is happening in most households? And I think it is, but I don't know. We'll see when the numbers come out.
And the sad thing is, that's what we need for rates to probably improve.
So you nailed that. And ultimately, good news is bad news for mortgage rates. Bad news economically, socially is really good news for mortgage rates. So, it's weird that we root for.
Yeah, that's weird because I don't actively want bad things to happen for the economy, but it's just, I guess when it does, it's good for us. But I'm just looking forward to the conversation changing on rates. I thought it was happening for a bit. Like the conversation was shifting from, man, rates are so high. When are they going to come down? Doom and gloom to, rates are better. Fed's cutting rates. It's going to be better. It's going to be great through the end of the year. And then just wait till 25. It'll be even better. And it just shows you how quick things can change.
Yeah. A buddy of mine, a former coworker, has been out of the business for a decade now. Mm-hmm. Rates go up, rates go down. You need to walk out of my office. But you and I are in it every day. So we're watching it all the time. And it is an emotional thing. Like, we want to help people. Lower rates make things easier for us. So right now we're in a bad run. We'll see what happens.
Hey, it is what it is. We've been through worse. So about that little mini refi boom that we had, I want to bring something up because I had a bunch of people quoted for refis. Yep. And I mean, I had some people that were going to save $700-800 a month, and they didn't pull the trigger because they said rates are going to get better and I don't want to do it just yet. So, okay. We didn't do it. And I was still of the impression that rates were going to keep going down. So I'm like, all right, yeah, sure. We'll continue to monitor it maybe a month from now, maybe a few months from now. But like, here we are with the highest rates that we've had in 4 or 5 months, and that refinancing is off the table. And the thing I want to point out about it is I did kind of give them the advice of like, you know what? We're looking at $700-800 a month of savings. And for other people, it was like $300 or $400, which I think was still good. It's like, we have this savings that we can get now. Like, how much further down do you think rates could really go? And I was unsure, but like, are we chasing a 0.25% lower rate to save an additional $60 a month? It's like where we can really capture $700-800 now. But if are we gonna wait 4 months for an extra $60 a month, meanwhile leaving $700-800 a month on the table of savings for that period of time? That'll be thousands and thousands of dollars chasing an additional $60 a month. So I guess my advice to people is like, when you're analyzing refinancing, the sooner I think you take advantage of it, the sooner you start getting that savings. And I don't know that it makes sense to just like chase a slightly better interest rate.
My thoughts on that is you just dominated the last 3 minutes. I don't really have anything to add to that. Dude, if interest rates don't get back to where they were a couple of weeks ago for the next 4 months, that's 4 months of $800. That's $3,200 that person.
Yeah, you could have saved just because you were chasing an extra $60. And maybe you do eventually get that lower rate in 6 months from now, and you're saving that you're saving that $860, and that's great. But like, it's going to take you 5 years to make up the $3,000 that you just lost because you waited till that point to get to it. So, anyways, I'm hesitant to use the word greedy because like, people aren't being greedy. It's just, there's that thought that it could keep getting better, getting better. But like, I think if it does make sense at one point, like, the smarter move is just to take action. We can always refinance people again. But I think a lot of people missed out on that quick window we had a few weeks ago.
I think ultimately, if you're listening to this, you need to know that things change minute by minute with mortgage-backed securities. What you're reading and what you're seeing online is to get you within that 5-second impression where you actually form an opinion on something. And at the end of the day, because interest rates move that quickly, I think you're really wasting your time worrying about what could happen 5 minutes from now. It's just an interesting game you play by not taking advantage of it when you have it. And when you do have it, are you cognizant enough to block out your aunt, your uncle, the newspaper, the news telling you that you could have got another quarter?
Yeah. So interest rates will continue to be an important discussion for us on this podcast. We'll bring it up and we will have discussions about it every month. Just know rates are higher now than they were a month ago, and they're probably back in line with what they were this summertime. And let's hope that better days are ahead.
Yep.
So, you want to talk about some other mortgage stuff, Beds?
Let's do it. What do you got?
So you were talking about this offline, but a lot of times people reach out to us and it could be out of the blue. It could be people we did a loan for 3 years ago, and they'd just be like, hey, Chris, my mortgage payment just went up by $250 a month. Like, why is that? Like, I think that's an important thing to address because, well, I'll let you answer, but like, I know that I'll tell you one thing that hasn't changed, and it's not the principal and interest on your loan. Like, typically we do people in fixed rate loans where the payment piece is itself. It's the other thing are the things that could potentially change. So why don't you explain that, Beds?
Yeah, PITI, principal, interest, taxes, and insurance. The PI part, that's the interest rate that you signed up for. That's locked for the period that you signed up for. That's never going to change. The TI part, taxes and insurance, also known as escrow, I describe it as a built-in piggy bank into your mortgage payment to pay your taxes and insurance in the future when those bills are due. we know that most towns in our area right now, we're in York County, um, everybody's taxes are going up right now. So the important thing to take from what I'm rambling about is that you're going to get a bill, and you're going to notice, if you pay attention to it, that year over year it's gone up between your tax bill and your insurance bill. Your mortgage company doesn't know immediately that those figures have gone up. There's no mechanism for them to know in live time. So if you're a borrower, you actually need to take a look at that difference, and you either notify your mortgage company so they can do an escrow analysis to correct your payment, or there's a little section on your coupon that says additional escrow. So right now, as an example, my taxes just went up $800+. So you take $800 divided by 12, whatever that figure is, we're paying that extra towards our mortgage, because escrow needs to be legally analyzed once a year. So if you go, let's say we have a change today and it's not analyzed for 11 months, that's 11 months of payment. In my case, the 40 something dollars difference that isn't being accounted for. So when I get in, when my escrow is analyzed, I'm behind $40 a month times that amount of months. Plus, my payment needs to go up for that correction. So it's like, just know when your clients are calling you and saying, "Why did my mortgage payment change?" The immediate answer is your tax and insurance bill went up.
And most of the time it's taxes. Yes, have I seen insurance bills go up? Yes, they'll go up a few $100 a year, but the tax changes are the biggest things over the past couple of years. Please know it's never the mortgage itself. We're probably doing a fixed rate mortgage. It's going to always be the taxes or insurance. So just please know that. We're always happy to explain it to you, but it's probably right there in the statements. I will say our taxes went up, like you said, it was lovely. And I saw that I had an escrow disbursement come out of my account, and I'm not necessarily worried about the shortage. I'll have a higher payment at that point. So I did see that they paid the higher amount. They'll pay a higher amount in the spring. I'll have a higher payment next year. And I just already kind of know that. It's very concerning when you just see it go up next month and you're just like, what the hell's going on? That's what it's going to be.
Something big to bring up too is, like, those bills come in. You need to pay attention to the mortgage statement to see the itemization of that, release of escrow to the town. People are human. People make mistakes. It's really up to us consumers to pay attention to our statements to make sure that the release of the taxes actually happens. So I've had a little bit of that recently, unfortunately. Make sure the taxes were paid. Make sure the insurance was paid.
No, it's a good call for sure. Things definitely get missed. It was just kind of the system messed up, or the town didn't mark it the right way. So it definitely happens. So you just want to monitor that stuff from month to month, as opposed to just shredding those statements or just throw them in the trash as soon as you get them. Just take a look, make sure that disbursements go out, make sure you have enough money in escrow and all that stuff. And again, we're always available to answer any questions that you have.
Are we feeling it right now?
Oh, dude, we're always feeling it, man. But yes, we are especially feeling it right now.
Yeah, right now I think we're running at about a 9.5 out of 10.
In this market,
yes,
it continues to be hard for borrowers to get FHA offers accepted.
Yes.
FHA is a government type loan. It's typically makes more sense for borrowers that have lower credit scores when compared to conventional financing, where it's a little harder for borrowers with bad credit scores to get approved for a mortgage. FHA is probably as easy of a loan to get approved for in general, but there are some stipulations on FHA loans that make it harder on the appraisal front. A lot of times peeling paint gets noted. Missing handrails on certain level of steps get noted. Those are the two big. So for that reason, it's gotten a bad rap in the market. Sellers try to avoid it, but there continues to be borrowers that should be in FHA financing. You just closed one for a borrower that had a credit score in the 580s.
Yes. Yep.
That's just about how low we can go. So anyways, we want to try to change the narrative a little bit on an FHA loan and just kind of share some news as to why, like, you really shouldn't overlook an FHA loan. Number one, like we said, it's very easy. And number two, this next thing that I want to share is important to know, and it's about doing an escrow holdback. Do people ever ask you about escrow holdbacks and what that is?
Pretty regularly. Escrow holdbacks, they're a nice option for FHA if you have things involving a subject to appraisal through that financing that are not function type of things, but they're more cosmetic things to escrow. Yeah.
The terms would be they're not structural or they're not safety related.
Yes.
So, in my mind, examples, and there's probably a million examples, but like structural would be like like a cracked foundation. You're not going to be able to escrow for a cracked foundation to have that fixed in the future. That's something that you're not able to close on until that's addressed. Health would be an attic full of mold. Like you're not going to be able to close and escrow for the money to fix the mold issue after. That's like an actual health issue. So outside of that, we probably can have it escrowed. And the biggest thing, honestly, with FHA loan, like 99% of the time, and I'm totally jinxing myself, 99% of the time it's peeling paint. That's like the thing that we see the most, right?
Yep.
That is neither a structural or a safety issue. Like we could do an escrow holdback for that up to $10,000. FHA allows up to $10,000 for escrow holdbacks. Would
Usually,
you? Yeah, go ahead.
sorry, usually at 1.5 times. So
Yep.
what that means is a quote a little bit over $6,000 to remedy something prior to closing is typically going to be in the sweet spot of being able to be escrowed.
Yeah. So let's talk about the mechanics of that. So we get an appraisal, comes back subject to peeling paint on the back side of the house, let's say, right? And in some worlds, that gets done before closing and it's fine. But in other words, the seller doesn't want anything to do with it, just out of not wanting to deal with it or not having money to deal with it. So in that case, we would escrow it. Like Chris said, you would get a quote for however much it's going to cost, and then you would withhold 1.5 times that amount in this side escrow account. Typically, that money is the buyer's money, right? If the paint needs to be done in the back and it's whatever amount of money, the buyer is going to pay 1.5 times that amount of money into this side escrow account. So the money is there for that work to be done. And then we close knowing that the money is there to fix that after the closing. Good news is for the buyer, as soon as that work gets done, we get a final inspection out there, money gets released to them, and we're on our way. It's really not as big of a deal as people make it seem.
Man, you are 2007 Brady right now. I'm loving this. You are dominating. I love the way you.
I feel like I'm just talking. But
No. What are things that come up on appraisals? It's flake and paint that you mentioned, but I usually like to say to people, if it doesn't meet the eye test, it's probably going to come up in an appraisal. So
yeah.
I guess that's one of the things that I always say. And usually some of these things that do come up are sort of town code related. I get a lot of questions. Hey, Chris, do you think this will be flagged on an FHA appraisal? And I always say, hey, look, what does it look like? And what is the town code? That's your answer.
Yeah. It is hard. In general, I want to be helpful to people, and I know you do too. So people ask that question. It's like we want to give them a thoughtful response and ease any concerns that they have. I don't know what the appraiser is going to say. And honestly, besides that, appraisers have good and bad days too. Like sometime an appraiser might miss something that, God, I've had it happen where we all get worked out about this one aspect. And, Randy, is this going to work? What do you think? Should we do this? Should we do that? And it's like, hey, let's see what the appraiser says. We get the appraisal, comes back, no mention of it. And it's just like, why do we get all worried about that for a couple hours at the beginning of the process? Like sometimes it makes sense to plan ahead. Totally get that. But then if you're in that window of, I don't know, like all you can really do is just roll the dice and deal with it when you get the appraisal back.
So I think sort of bringing this full circle, if it's not something huge, if it's cosmetic related, if it's going to be under $10,000.
Yeah, for sure. And honestly, if it is something bigger than that, if it is a roof that's not functioning, that's going to be a problem regardless, So that's not like a FHA, if the septic tank's failing or, if there's giant cracks in the foundation, those things are health and safety issues that are not just issues for FHA. So again, FHA gets a bad rap, but don't overlook it because I think it does make a lot of sense for a lot of people.
This is a government-based thought process. So we're talking about FHA, VAs underneath this thought process, rural developments underneath this thought process. So those loans sort of are in the same circle.
Yep. So what else you got, Beds? Anything else?
You know what? We could talk about a product scenario that you and I chatted about prior to hopping online here is that CMG does this type of philosophy.
Mm-hmm.
So this is a non-QM conversation.
Oh, yeah. Yep.
I have a client that's under contract that I'm doing a loan for that's going well right now that does not have 2 years of work history as a self-employed borrower, but is selling a home, is going to make a decent amount of money, has a higher FICO score, which is really your ability to repay. So sort of laying the tracks to simply say, I'm doing a loan for this client. He's only been in business a year and change, non-QM, 35% down, and I'm making 3 other transactions happen because this guy's able to purchase something. So that's a pretty cool scenario that I wanted to throw out there. It doesn't apply to everybody. It's got to make sense. You got to have a good credit score, down payment, greater than 20% down. We're doing this via bank statements, 12 months business bank statements.
It's a great product. This person would probably never have an opportunity to buy otherwise. If they went to a different type of lender, a different bank, they would see what their income is on their tax return. They'd be like, nope, can't do it. In my case, they have a longer history. They just keep it super skinny. In your case, they just don't have the normal history that's required. And it's nice to be able to have these lenders that kind of work outside of that box, take the bank statements, come up with an income, and then use that. Big thing to note, though, is the big down payment, because someone that has no money down or 5% down or 3% down or FHA, and they're like, oh, this sounds great. It's like, please know, like, it is a little bit different. You do have to have a bigger down payment, and that does separate a lot of the people that might be interested in it.
I would describe the interest rate as not Fannie and Freddie interest rates, but not hard money interest rates, which just probably 20-25% higher than what your street rate is. But I mean, there's some risk there, so the interest rate's going to be higher. But in the case with this borrower, we had a conversation. Hey, look, year 2, you'll have 2 years of tax returns. You'll be a traditional mortgage. We could refinance you then. So it's almost a 2-tier for me, which at the end of the day is good for me. Provided the structure of getting them in traditional financing after the fact to refinance.
Love it. So again, that's called a non-QM, non-qualified mortgage. These would be in the same bucket as something like a DSCR loan, debt service coverage ratio loan. Some of the type of loans that we have can take into account short-term rental income with those type of loans as well, which is pretty unique compared to some of the Fannie Freddie stuff. So it's like we have this bucket of normal things, conventional FHA, USDA, VA, but then we also have this bucket of non-QM stuff, which is a little bit more unique. So always keep that in mind for us as well.
Love it.
So, but Beds,
yes,
if you're good with it, man, I think that's all I have for the mortgage show this month. Pretty easy, big focus on interest rates, few products, but I'm sure there'll be some bigger news next month.
We'll see what happens with interest rates. It's always a fun topic. We'll see next month where we sit.
And as always, if there's anything we do to help, whether it's you, someone that you're working with, someone that you know, we're happy to answer questions mortgage related, run numbers, get pre-quals done, pre-approvals done, and do anything we can to help. Thanks for listening. We'll see you next month.